Okay, we've got Gary Schlossberg, Global Strategist at Wells Fargo Investment Institute, joining in now. Gary, great to have you back on the program. Thank you. Let's start with the contention that the U.S. debt deal will get done. I mean, if you think otherwise, please explain. But let's just, assuming that it gets done, my question is, will that be a trigger for markets to break out, both in the U.S. and, markets like India, which have been waiting just under their all-time highs, but not quite taking it out? What's your sense?
Yes, we think that there will be a brief risk-on rally if, as we expect and you expect, there is a deal. Looks like the deal will be consummated sometime over the weekend. We could see a House vote in one part of the Congress on Tuesday, the Senate following. We do think it'll beat that June 1st deadline. That we think will trigger a brief risk-on trading. As I said, stock markets in the U.S. and overseas will benefit. However, out beyond that, a bit more challenging environment, certainly in the U.S. market. Liquidity will be tightening up. The Treasury technically has to issue a large volume of Treasury bills to rebuild their cash balance. Longer-term spending cuts will take the edge off economic growth a bit. The combination of the two could increase the possibility of that recession that we've been forecasting by the end of the year. And that becomes more of a headwind for the market here and to some extent overseas as well.
Okay. Gary, hi, good morning, and thank you for speaking to CNBC-TV18. We got a report from Jefferies this morning. Chris Wood of Jefferies writes his Greed and Fear report every week. And this week he mentions that when you look at the Indian market, it's not as expensive as it used to be, both in absolute terms and relative to the region. And there is also now a narrative that earnings growth is catching up with valuation. So in that context, perhaps India looks attractive compared to its peers. Would you agree? And what is your own view on the Indian markets now?
Yes, I would agree. The fundamentals look good. Valuations were an issue at one time. They have, as you mentioned, been coming off. But growth is holding up well. We do expect to see first quarter growth, the estimate picking up speed from the fourth quarter of last year. The fundamentals on growth are holding up well. Inflation is coming off a bit. If there is a caveat out there, it's tightening global liquidity conditions emanating in part from the U.S., but also further credit tightening overseas. And OPEC still could come through with production cuts, which could trigger a rebound in oil prices. But absent that, reasonably good growth by world standards, very good. And inflation does seem to be coming off. The Reserve Bank of India moving to the sidelines to some extent. So numerous tailwinds, a couple of headwinds that we're keeping an eye on. But all in all, on net, India looks like a good play right now.
Oh, that's good, Gary, because of just looking at your view, you're shifting, tilting more towards the DMs in comparison to the EMs, I believe, at current reckoning. Could you tell us what is the preference out there? And also, good to hear that you believe that a deal is going to be done. The debt ceilings gets raised, which triggers a bit of a relief rally. But what about rate hikes? Suddenly an outside chance has come about that we see another rate hike coming in June. Are you in that camp?
Yes, we think that if not June, it's not a done deal. A lot depends on the data. The Fed still may be inclined to pause, just given the very rapid run-up in interest rates over the past 12 or 14 months. But we do think there's a good possibility of at least one more rate hike out there, just given the inflation news we've been getting, the resilience of the economy. If, in fact, the economy begins to lose momentum during the closing months of 2023, we're more inclined toward a Fed pause. Rate cuts really not coming until we're well into 2024.
Rate cuts only in 24, even if you get a pause, right? I mean, in June. So, yeah, hike, no hike, but cuts are still a distance away. Gary, any other sort of themes that you at Wells Fargo, or themes sometimes work globally, right? Growth, value, anything which you strongly believe in. The team at Wells Fargo strongly believes that it's likely to do very well over the next couple of months.
Well, on the equity side, to that first question earlier, we are maintaining a defensive posture for now. Typically, the stock market doesn't bottom out until several months after the Federal Reserve has finished raising interest rates. And we haven't even entered into a recession yet, as best we can tell. So we still maintain that defensive posture, less economically sensitive sectors of the market like healthcare, high quality liquid stocks, the large cap area of the market, more cautious on tech. Keep in mind that has been the main driver of the market. The rest of the market itself has been a bit more fragile. And that raises questions about the longer term outlook for the S&P 500 as well. As we move through that slowdown, though, the market does anticipate. And for that reason, we are keeping a close watch on developed markets overseas and emerging markets for that turn in the economy here and overseas. And that would represent a fundamental shift in policy. But for now, at least, we remain in a defensive mode ahead of what we think will be a recession in the U.S. very late this year or by early 2024.
Just a final question from mine before we let you go. It seems obvious that if the monetary tightening cycle is over and there is a rate cutting cycle that comes through, then a lot of rate sensitives, especially in markets like India, would do well, whether it's banking, autos, or even real estate, which is entering into an upcycle after 10 years of a lull. Is this the way to approach the market, that you continue to stick with the rate sensitives even in a market like India?
Well, I think in India, we do see inflation holding the line, at least for now, and the Reserve Bank moving to the sidelines. So those rate-sensitive sectors do look a bit more attractive. In the U.S. and even more so overseas in Europe, we still think we're on the upside of a rate increase cycle. Close to the end in the U.S., a little more extended in Europe. And for that reason, and given the fundamentals, when we refer to real estate, weak fundamentals in both areas, we'd be more guarded on those rate-sensitive sectors of the economy. We're close to the top, and that could represent a turn later this year. But we think at this point, a little premature, particularly in that real estate sector, which we're very guarded on.
All right, Gary, final question. I'm hoping it doesn't happen, but if we have one more rate hike in store from the Fed, how much do you think equity markets correct? Because I'll tell you what, the commentary for the last 45 days to 60 days, everyone's talking about this pause, and then we don't see any more hikes, and suddenly that's coming back to bite us. So what if we get another rate hike? What happens to global equity markets?
Well, I think there would be some disappointment there, but close on to that, we do think there will be that slowing in the economy, which really represents the driving force. And at that point, rates may move lower in a more guarded outlook for the stock market. Those rate-sensitive sectors may be looking a bit more attractive as it becomes clearer that we are at the top and we're beginning to move lower on interest rates. But it is going to be a difficult period for the market, if not rate increases. A slowing economy, Europe, the Eurozone, already to some is in a technical recession, given those back-to-back declines in GDP. Real GDP, and just a more difficult environment there overseas. So I think that's the bigger issue as we move into the second half of the year. The rate hikes, I think, certainly in the U.S., investors will be looking beyond perhaps one more rate increase. The market is already beginning to price it and beginning to focus on the economy itself, we think, later in the year.
All right, Gary, great to have you with us here.
Thank you.
It's often, as you said, a timing issue, right? I mean, you expect a recession, but, well, the timing of it is so unpredictable, and we've been waiting for it for a while for it to show up, start to show up. Well, nothing yet. And now we're talking about a rate hike. It's June. So interesting, as always, markets. Gary, good to have you with us here again. Thank you.
Thank you very much. Bye-bye.
We'll take a very quick commercial break here. We'll come back, and we have, of course, our research team joining in with the list of top 10 stocks that we will get for you, results, non-results, news, everything coming up.